Emergency stock market update, what you need to know. This is an emergency update because the stock market blew up Friday. We felt it was important to get a summary of Friday's market out to explain to you what is happening and what is not happening, why the market in certain areas blew up, and most importantly, what not to do about it. Plenty of people are going to make some massive stupid mistakes, and we want to make sure that that doesn't happen to you. Current market situation. Right off the bat, the stock market was down on Friday. It was down 2.5% at one point. The NASDAQ was down 2.5%, the Dow was down 2%, and the Russell 2000 was down 3.5% and at one point down 4%. So stocks have fallen off a cliff, or at least that's what it looks like. This is one of the more important things that we're going to focus on, which is the VIX. The VIX was up around 35%, starting the day around 25%, and it seemed to settle out around 30%. So, number one, stocks are down big, and number two, the VIX is up big. Bond market movements. Another thing you'll notice if you look at the markets from Friday is that short-term rates are down huge. People are buying up short-term bonds like crazy. The 6-month US Treasury was down 3.6% on Friday, the 1-year was down 5.5%, and the 2-year was down almost 6%. The 10-year was down less, it was down around 4%, the 20-year was down around 3.5%, and the 30-year yield was down around 3.5%. This was a flattening of parts of the yield curve, especially the 2 and 10-year, with the 2 being down 6% and the 10 being down only 4%. This is known as a bull steepener because the short end of the curve, those bond prices are moving up faster than the long end of the curve. It's bullish for the short-term bond owners rather than a bear steepener, which would happen from long-term rates rising. This is an anticipation of the Fed cutting rates. Federal Reserve and unemployment rate. One of the reasons why we have the Fed expectations of cutting rates is because of this. The U.S. unemployment rate rose again unexpectedly. It rose more than the market expected, not only that the unemployment rate rose, but also the hiring slowed as well. Both of these are things that the Federal Reserve has been saying they are watching. If the jobs market slows down too much, they don't want to keep things tight too long to trigger a recession. So these numbers coming out worse than expected indicate a higher chance of the market getting those rate cuts. In fact, right now, the market is now pricing in like a 75% chance that the Fed will cut rates not by 0.25%, but by 0.5% in September. Stock market performance. Let's talk about the stock market. Amazon, at one point, was down as much as 12 or 13%. This is one of the reasons why the stock market has had some subperformance lately, but also recently started to fall off the cliff. Thursday was a big red day. Friday was a big red day. Earnings numbers have been coming out well below expectations for a lot of companies. Another one was Intel. They were down 12% after hours Thursday, and down around 27% today because they just came out with terrible earnings. We're seeing earnings numbers turn over, indicating problems with the economy and the stock market. Volatility and short volatility trade. A lot of people are looking at this and thinking, okay, well, the crash is here, and we think that might be a mistake. One reason that we at All Things Money think is being overlooked is the unwind of the short volatility trade. For almost a year now, we've been warning about the short volatility trade blowing up at some point. The VIX is a measure of volatility on the stock market, measured by looking at the price of at-the-money options on SPX. When the VIX is low, the market is pricing in a low chance of volatility because options prices are very cheap. Shorting volatility is basically betting against volatility. So essentially we're saying that volatility is something that naturally bleeds out, it's not something that can just go up in perpetuity. There's been a strategy called shorting volatility, where you collect massive amounts of income for what seems like almost no risk. But it's like playing the house of a lottery. One time you're wrong, you blow up, and that's what's happening right now. How to play the market. So what to do instead? Number 1, buy more of your good name stocks. For example, we like Amazon for the long term. On a day like Friday, if we are not treating this like a trader, we're treating this like an investor. We're saying, over the long term, Amazon stock increases in value. When you have drops in the market like Friday, those are opportunities to buy more shares at discount prices. Number 2, take profits of hedges and shorts. You should have had some hedges and shorts in place because markets were extremely overvalued recently and hedging was very cheap. Days like Friday, when you have big unreasonable drops, that's when you take some profits from your hedges. Number 3, if you think this could be the start of something bigger, you don't want to pile into puts or shorts on a day like Friday. You want to wait for a bounce because then the price becomes a lot lower. You can still have profit potential because you're buying it cheaper, which means you have lower downside potential if it doesn't go your way. Conclusion: the current market turmoil is a test for investors. While the temptation to react impulsively is strong, maintaining a strategic approach can help navigate these choppy waters. Keep an eye on key economic indicators and Federal Reserve actions, and focus on long-term investment opportunities. By staying informed and avoiding knee-jerk reactions, you can protect your portfolio and potentially benefit from market corrections. Stay tuned for further updates as we continue to monitor this evolving situation.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.